Hello Forex traders, welcome back to FX Globe YouTube channel. Did you know that as good as order block is, it is not the only institutional reference points that there is in the smart money concept. There are several other institutional reference points that are more powerful and price respects them more than an order block. So in this video, I'll be going through every single institutional reference point that is in the smart money concept. We have 7 of them, and there are other ones that are auxiliary. I'll be going through the 7 major institutional reference points throughout the videos I'll be posting on this YouTube channel. So in today's video, I'll basically be introducing you to the first institutional reference point, which is a mitigation block. Now we have 7 of them. These are arranged according to their order of importance. So if I go through every single one of them in different videos, you would be able to understand how they form and how we use them for trade entry. So you may consider subscribing and also watching all the remaining videos, because this is the first one I will be making. So let me go into explaining what exactly is a mitigation block. Now, a mitigation block is an institutional reference point, just like every other institutional reference point that you know. The most popular is actually an order block, and then maybe a fair value gap that you know. So let me show you an example of a mitigation block. Now we always want to use a pattern to describe what a mitigation block is. Look at this. If you have price, you know, going up, going up, going up, going up, and then you have this kind of a pattern forming where you see price tries to go up but then had a failure swing as price went up here, creating this high, come back inside. On its way going back, it had difficulty in breaking the previous record but then crashing down into this area, creating a shifting market structure. Now this is where it's important for you to pay attention. The mitigation block is basically the last candle here that price created before taking this last upward movement. Don't worry if you don't understand. As soon as I go to my chart, I will show you how to literally identify it. So just like we have a bullish order block and a bearish order block, we also have a bullish mitigation block and a bearish mitigation block. So why do we give them that name? It is simply because of the action that follows suit after price comes back to that particular institutional reference point. So in this case, we have a bearish mitigation block. So this last sell candle that price printed, if price begins to retrace back, we want to see it get rejected from this candlestick, and then that becomes the mitigation block. It becomes the mitigation block. So this particular candlestick, which was a sell candle, we can literally see it becomes your bearish mitigation block. Please don't forget about this very simple concept. So we will mark this guy and expect price to be rejected around it, this guy, as a bearish mitigation block, and then price quickly running downward. If we want to see a bullish mitigation block, it is the exact opposite of this. Price comes like this, creating this failure swing, and boom, going up. If price comes back here, it will definitely be rejected from this last buy candle, because as price is going up, you expect to see a bullish candle printing upward. Please get this correctly. Now there is a very important lesson here. In a mitigation block, this guy is always lower than this. I am saying this because by the time I begin to explain a breaker block, you will have to pay attention to this. So the right hand side of our M formation, or our W, the right hand side is always lower than the left hand side. It is always lower than the left hand side. Look at this. It's lower than here. So this is how a mitigation block forms. So if I kindly go to my charts right here, you see these things always form around a particular area in a trend. So if I decide to clean everything here, look at this price. Price came here. I just want you to have this pattern in your mind. Price came here, retraced, pushing lower, and then what did you see? Did you have a mitigation block formation here? Just take this guy out here. Did you see the right hand side actually lower than this? Actually higher than this? Because this is it. If you're going to measure it, this guy is like this drawing. I just want to show you correctly. This one from here to here. Can you see? So this is it. The lowest point here was here, and then the right hand side is here. So definitely the right hand side in this regard is higher, and we consider this as a mitigation block. And what did we say becomes the mitigation block? The last buy candle becomes your bullish mitigation block. So notice how price respected that area, came here, retraced, crashing, going back up, now creating a shifting structure, and then boom, after touching this last buy candle, and boom, it went up. That is a typical example of a bullish mitigation block. Please don't forget, a bullish mitigation block. Let me just look for a bearish mitigation block and show you an example. Here is a typical example of a bearish mitigation block. Guys, please, you don't always have to see a perfect M formation. Just try as much as possible to get that pattern. You see right up here, crashing here, taking up again. And did you have an M formation giving you a bearish mitigation block? So as price came back, what is your mitigation block here? So in this regard, you will look for the last sell candle that price printed, and that becomes your mitigation block. So as soon as price comes back to that place, it gives you an opportunity to sell. It quickly run away from that place, and you can see how a bearish mitigation block forms. Perfect one. Now the question is, can we consider this a bearish mitigation block? Look at this. Look at this. As price came up here, creating this low, taking up here, crashing. This is a bearish mitigation block, in as much as we have not seen price come back to the last sell candle. Don't forget which of them is your mitigation. Is the last sell candle, since we are dealing with a bearish. We are expecting price to crash down immediately after it touches it. Look at it. Notice how price came here. Here, look at how long it took for price to react from that mitigation block quickly. And boom, price went downward. So it's as easy as this. This is how to literally identify a mitigation block, guys. And when I go through all the other institutional reference points, you will begin to see how important it is to have a knowledge that will help you to be able to trade with this information. I will bring everything together and give you the best knowledge you need for trading. If you go through your chart, you're going to see them time and again and again and again. This is it. Boom, boom, a bullish mitigation block. Notice how price came back, touching this area, and ooh, it went up to that side. A mitigation block is always going to reject price. Notice how price did here. Look at this, the last sell candle. Notice how price created this and came back to this area. The precision is powerful. And boom, price went downward, creating another mitigation block here. You see this guy was a mitigation block. Price actually, did price touch it? Oh, just a little, remaining small for it to be active. But then you can see how powerful a mitigation block is, guys. Thank you very much for watching. I hope this video helps you. Make sure you subscribe. I will make a video explaining a breaker block also. Thank you. See you in another video.